Hello and welcome to the Assay TV. Today I'm really here to be on site at PDAC with Matt Geiger, fund manager at MJG Capital. So Matt, thanks for joining me
today. It's great to be here, Amy. Thanks for having me.
So maybe we could just start with a bit of background to your professional career and your role at MJG Capital.
Sure. Well, I'm managing partner of the fund. We're based out of San Francisco. We have about 30 limited partners, and we're exclusively focused on natural resource equities. I will say we have a heavy skew to the junior end of the market. Over 17 current positions. The median market cap is roughly 40 million Canadian as it stands. And we do only equity investments, so no convertible debt, no royalties. Our positions are initiated either through open market purchases or through private placements, which is a very big part of what we do. And my background is originally financial. But I've been in this for 13 years now, so I've certainly picked up a lot of geology and mining engineering along the way.
Definitely. So can you talk a little bit more about the investment strategy at the firm and what sort of areas of focus you have?
Sure. So I try to think about everything from a bottom-up basis and really try to de-emphasize the commodity of focus. I see a lot of new investors that come into the space get caught up in whatever the flavor of the month is commodity-wise, and I think that's a good way to lose money over time. So the first thing I look at is people. Are they highly incentivized? Are they qualified for the task at hand? Then move on to the project. You want a promising project that, very importantly, has enough scale to matter. Then I look at the company's structure, make sure that it's a serviceable financial structure. Then I look at upcoming catalysts and see whether there are milestones in the calendar that have the potential to drive a re-rate and share price value if the unanswered question is answered to the affirmative. Then you must look to price to value. So how is the company priced currently? And where do you deem fair or expected value to be? And if there's a significant discrepancy, that could be an opportunity. And only then do I really look at the jurisdiction and commodity. So I do consider the commodity, but it's kind of one of the last boxes that's important to be checked. And I will just say, in terms of portfolio construction, as mentioned, we're heavily weighted to the junior end of the market. Roughly 55% of the weighted portfolio as it stands is exposed to either prospect generators or explorers. Then roughly 25% of the portfolio are exposed to development stage companies. And then we have roughly a 20% weighting to royalty and streaming names. We actually only have one producing miner within the portfolio. And the majority, if not vast majority of our portfolio are pre-revenue companies.
Okay, sounds good. And so, where are you seeing most momentum in the resources sector at the moment? Investment patterns or, where is that interest going?
Sure. So I think to start 2025, one thing that I've noted is the producers are actually showing leverage to metal prices, particularly on the precious metal front. So that's a bit of a change from what we saw last year. Last year, the price of gold was up 27% over the course of 2024. Where you look at the GDX, GDXJ, they were up roughly 10% a piece. So significant underperformance relative to the underlying metal. At least to start the year, we have gold up 12 or 13%. And a lot of the bigger producers are up 20% plus. So I think that's encouraging for the mining space at large. And we could be in the beginning stages of a trickle down effect. Another key thematic at the moment, I would say, are the military metals or defense metals, tungsten or antimony. We're hearing a lot of chatter in the halls of PDAC about those two metals in particular. And then in terms of a key thematic that I think we're going to see play out continually over the course of 2025, it's gold M&A, plain and simple. I think there are multiple reasons for that, but the two key ones would be Newmont just concluding its strategic sale process. Over the course of the past 12 months, they worked through 6 different assets, concluding with the sale of the Porcupine complex to Discovery Silver. That was just in January. And they're done. And that's important because for each and every one of those asset sales, they had 20, 30, in some cases 40 groups in the data room evaluating whether it's a deal worthwhile. And mining companies are surprisingly constrained in terms of their due diligence capacity. So now these teams can be freed up and look elsewhere within the space. And then I'd also argue that the fact that gold isn't being grouped, and silver as well, isn't being grouped into the broader critical minerals basket is important because this allows Chinese parties to come in and make acquisitions. We've seen Zijin be super active over the past year with 3 or 4 different acquisitions. They've also done a couple strategic investments with the Lundin Group in Africa, Montage Group. That would have been spring of last year. And then very recently, Zijin and the Lundins made a strategic investment into Predictive and their Bankin project in Guinea. I would argue that all else equal, if those projects were focused really on anything other than gold, you wouldn't see these two parties working together. So I think that opens the playing field for a whole host of additional suitors than if gold was critical mineral focused.
Yeah, absolutely. So, I mean, apart from kind of this M&A in the gold space, there has been a significant amount of kind of underinvestment in the market, especially amongst the critical minerals.
That's right.
You know, there's been talk of this looming supply gap. So, you know, what are some of the key risks, and how do you think we kind of bring that focus back? Yeah,
I mean, we're going on 12, 13 years now of severe underinvestment in the extractive industry. And I would argue it goes beyond just the extractives, whether you look at agriculture, whether you look at infrastructure, whether you look at manufacturing. Like, it's been a very long period of the new economy outshining the old economy. And we have seen some government response in the post-COVID period in order to incentivize investment in kind of the old economy sphere. You know, we saw a more cooperative approach under the Biden administration with critical mineral partnerships and cooperation with allies. Now we're seeing what I would describe as a more ham-handed approach in the early stages of the Trump administration, just slapping tariffs on anything. But either way, we are seeing some reaction to that from Western governments. The issue is in private capital markets. Like, investors have been making money hand over fist here for a long time, investing in U.S. large cap equities, investing in high-flying tech companies, investing in cryptocurrencies. And I would argue until investors actually start losing significant sums of money in those spaces, we're not going to see private capital markets turn its eyes to the extractive industry and to some of these other old economy industries. And that's going to have big implications, long-term implications for the Western world. Yeah. And even if it started tomorrow, this 12-year wait is going to have implications on the inflationary front. There's going to be shortages of the critical minerals needed for the energy transition for those that are worried about that. There's extreme reliance on foreign adversaries for the military hardware that's necessary to defend the Western world. There's been a lack of investment in the infrastructure that's needed for sustainable economic growth in the Western world. There's even the potential for food shortages. So I think this is a very serious, slow-moving problem, but it's going to take private capital markets to turn their attention back to the space before we start to see it get addressed. Yeah, absolutely. And so finally, we're here at PDAC in Toronto. There's a load of Canadian companies, TSX-listed companies. Is there something that makes those particular companies stand out as opposed to kind of other resources companies globally? Is there interest from your team? Yeah, I mean, I'd say I come to this conference with three main aims. Like, the first is to catch up with existing holdings. Like, there's no better place to do this as one of the two largest mining conferences in the world. So I think by the time I board the plane, I'll have caught up with close to half of the portfolio. So that's a pretty good haul for any given conference. I also will sit down with like-minded investors, whether it's over dinner or over drinks, to trade ideas, to trade industry gossip, and try to refine my framework for how I'm thinking about things. And there's also many companies out there that may not be a current holding within the MJG portfolio, but they're on my short watch list, and I could see the names being added to the portfolio at some point. So this is a great opportunity to catch up with those teams, kind of get a progress update, and see if there's an opportunity for us to add them to the ultimate portfolio. So that's what I come here to do ultimately. Sounds great. Well, I hope you have a very successful PDAC, and thanks for joining me here today at the Assay. Oh, that was fun. Thanks, Amy. Appreciate it.